Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 6, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And all in all, it was a very, very quiet day out in the market today. The volume was extremely light. Coming in at just around 53.5 million shares in the SPDR, and that's about the third or fourth lightest volume day of the year. So we can't make much out of the activity today in the market because of the light volume. There wasn't a lot of institutional participation, which means that the market was basically floating around for the majority of the day. We did see some selling pressure early in the day, but again, without light volume, it's very difficult for the market to get any kind of momentum on the downside, and therefore, as always, the path of least resistance is to the upside. So from a shorter term perspective, there are a couple of things that are worth noting. So what I'd like to do is go down to an hourly chart, and what you'll notice is we came today, we actually opened up, let's see, where the opening was, the market opened at 237.50, and that's ironic because the number that we had cited from last week was 237.50. So the market opened up on the number that it could not satisfy last Friday, and we traded slightly lower than that, and then recovering based on the light volume and floated higher for the remainder of the day for the most part, with exception of the last few minutes of the trading day. So what we have here in front of us is an interesting scenario. We have the 236.50 that happens to be a gap fill area. Now the market under normal conditions should get down to fill that gap. And if it does by chance, for example tomorrow, go down and fill that gap, I think that would be somewhat of a gift because following a gap fill, the market would be likely to stage another rally, making a turn either tomorrow or potentially on Wednesday. Now, why do I say that? Well, let's go back to the daily chart for a second. So what we have here is the market made a pivot high on March 1st. Tomorrow would mark the fifth day if we were able to fill that gap tomorrow. Now, generally speaking, I like to see the market consolidate for 6 or 7 days before making a turn. And, if we come up one day short, that's okay too. But generally speaking, if we came down tomorrow to fill the gap, maybe slightly lower, we would come into an area of a reasonable amount of chart support. So what I'm referring to is this area here has chart support. And why is that? Because the market spent about a week, what I call vibrating around that area or consolidating around that area for that push higher on the 1st of March. It's common and expected behavior for the market to come back and retest former breakout points. That, coupled with the fact that it's a gap or a gap fill down at 236.50, and about a week of consolidation with the 20-period moving average sloping up into that area. While it's still slightly below that, it is sloping up into that area, which would provide somewhat of a safety net. It makes sense that the market would find support in that zone around 236.50 based on the price, the gap fill, the time, the consolidation, and the market coming back to retest the breakout point. All those things line up. The more reasons on the chart you have to support a case such as I just made, the more likely it's going to be an area that would be a buying opportunity for the market down at the 236.50. Now, there's also two more reasons. One is the longer term cycle that's really up into the middle of the year still remains with a grip on the market. So therefore, as long as the cycle is up, you want to be a buyer into dips. It's part of the buy the dip crowd or the buy the dip mentality. When the market changes its character, that's a different story. But right now, the market is bullish. This is just a pullback. And under normal conditions, based on my work, there should be higher prices ahead. Before this rally is over, before any meaningful correction, my work tells me that we should reach around $246 on the spider. So therefore, buybacks are meant to be bought for a further rally. Moving along, let's go over to the IWM, which saw some selling pressure today, more so than the spider. We made an attempt, but came up short of the 50-period moving average on the daily chart. But as you can see, the market was very, very weak in comparison to the spider early on, and then recovered, as did the spider, with the light volume into the middle part and the latter part of the day. If the market were strong, I would expect the IWM to be outpacing the spider on the upside. Rather, it's outpacing on the downside, which also supports the case to an extent that there may be some more downside coming sooner than later. But similar to the spider, the volume on the IWM was rather light today, and therefore you just can't read too much into the market activity on really, really light volume. All in all, from a longer-term perspective, just like the spider, there's nothing wrong with this market. It's in a bullish position, remains in an uptrend, and higher prices should be forthcoming. Just to give you a different look, we can go over to the weekly chart, and what you'll see here is the market can come all the way down to retest these lows here into, for example, the 20-period moving average down here at 133 and change, and still be in a very, very bullish position. As you can see, there's absolutely nothing wrong with this market. This is a bullish position. It's an up move, and this is a bull flag on the weekly chart. This is telling us that higher prices are coming. So what we're in the middle of now, and what is most likely going to end relatively quickly, is just a pullback. What I did notice today, and have been noticing over the last couple of days, is the media is getting rather bearish in comparison to what they were just a week or two ago. And what that tells me is that there's limited downside. Generally speaking, when the media and the pundits on TV get bearish, generally the market will go in the other direction. This means to the upside. It's the point in time in which everybody is at maximum bullishness. That's when you start looking for downside. Right now, it's just a pullback in the larger uptrend. And when you see this on a weekly chart with the moving averages upsloping and the moving averages have plenty of spacing in them, this is telling you that the uptrend is strong and is likely to continue for some time to come. All right, let's head over to the transports, which is a similar story. We saw a down day in the transports, down about 0.75%. But all in all, when you leave it on the weekly chart, you can see here there's absolutely nothing wrong here. This is in a bullish uptrend. Even on the transports, the spacing in between the moving averages is widening. And when you see that, that is a sign of strength. That's a market that is strengthening, not weakening. So there's more upside coming in the transports. When you go back down to the the daily chart, again, all we did was pierce through the 20-period moving average, closed about right on it. There's nothing wrong with this market. It's in a bullish position. Whether or not we come down to test the 20 or even slightly below, the 50, which is the blue sloping trend line, or slightly below, is not going to really matter. It's not going to break this uptrend in the least. In order for us to see a sell signal in the transports, for example, we really have to break below about 8,900 in the transports for a sell signal to trigger, and we're nowhere near that. That's 500 points away. I don't see that happening anytime soon. Heading over to the gold market today, you'll notice that the low today happened to be 1225 on the button. Let me move this over and you can see on low today, 1225.0. Interesting that our number was $1,225. Now the gold market was down from where the market closed on Friday after hours, or after the pit session closed on Friday. The market was trading up and we traded down today from that point, and that's why you see the red candle, but it looks like the gold market was flat, only down $1. But all in all, from the electronic session on Friday, it was down, I think, about $8 or $9. Now, we should be, under normal conditions, finding some kind of a low in this zone. We've been down for 6 days in a row. Well, not necessarily down 6 days in a row, but down 6 days from the pivot high up here. And we're finding support, as I talk about it, from the 1225 area. If the market should break below 1225 and begin closing below this level hourly, and then, of course, a daily close, we'll most likely want to go test the 50-period moving average all the way down at 1207. That is a possibility, but would not necessarily break the uptrend. That would only bring us in between a 382 retrace and a 50% retrace, which is normal market activity, garden variety. What that does is it generally shakes out the weak hands. Those are the last participants in the market as it was moving higher. They finally begin to sell or capitulate out at the point in which we get down to a 382 or a 50% retrace, and then that becomes the point in which we see another reversal. I don't know that we'll get down there. I'm just saying if we got below the 1225, that would be the next major area of support. So either we get going on the upside again relatively quickly, or we could potentially put in a bearish pattern or even sell off further from here. So it's one day at a time for gold, watching it closely. Taking a look over at silver, you can see here, as we discussed last week, we could potentially be putting in a bearish wedge pattern off of the big down day that we saw, what was that, on the 2nd of March. The only way out of more downside in silver would really be to first recapture the 20-period moving average, and then close by above that is the 200-period moving average. If we were to recapture those moving averages on the upside, that would somewhat, I wouldn't say negate the down move, but somewhat would soften the down move, if you will. It would more become, in my mind, of a one-day wonder than the beginning of another down move. Just to put it in perspective, from the low to the high, low being here, high being here, this is not even a 382 retrace. So under normal conditions, we're going to retrace at some point in time during rallies, 382 or 50% or deeper of a move. So it's not uncommon for that to take place, and it's healthy, normal, garden variety activity. So net-net, there's really nothing wrong with the silver market either. If it wanted to come back down lower, you're going to have a lot of support here, which was a breakout point, a lot of chart support here, which is a consolidation point, an important number of 17. There's tons of support in this area. The 50-period moving average happens to coincide with the breakout point and this chart support. So even if the market came down out of this bearish pattern like this, let's say we did this, and then we had a down move, we would find support at around 17.25 or so, give or take, and that would be a normal garden variety retrace, nothing wrong with the market, still in an uptrend, still bullish, still higher prices coming. All right, next up, we go over to crude oil. Crude was flat today. We tested the 20-period moving average, backed off, finished basically unchanged for the most part within pennies. Hard to read anything into this one way or the other. We're either going to rally and jump above the moving averages, which would also be above the important 53.79, that would put the market back in a bullish position, or we continue to go sideways, which would be making a bearish pattern, and that would potentially be setting up for lower prices, potentially trading down to the 200 period moving average or slightly lower, down to 51.49. Again, same story. We're in the middle of a range, and the range being your lows all the way down here, your highs up here. We're in the middle of a range, nothing to do until we have a clear picture and a clear pattern to trade from. Other than that, we just watch. We're spectators. We're spectators until and unless the crude oil market gives us an indication one way or the other of what the next likely or high probability move is. Today we don't have that, so we just wait until the market gives it to us, and when it does, we should be able to recognize it. Going over to bonds. Bonds are hovering around our trend line. So pretty soon it's make it or break it time for bonds. We're either going to continue making a sideways bearish pattern, and that would likely lead to a break of the trend line that's drawn in here, or we're going to begin to rally, and we'll have to get obviously above the moving averages, and if we do, that will be a bullish sign. Today, it's very difficult to say one way or the other. We need more evidence. We need the market to give us an indication one way or the other of what the next likely move is, very similar to crude oil. Nothing to do in the bond market, just a spectator. Longer term, higher prices are coming. In the short term, anything can happen. Just need a signal one way or the other. And the last market we'll cover tonight is the US dollar. So we remain above the moving averages, which is somewhat bullish, but I'm not sold on the bull case yet, as I've been saying over the last several sessions. It's more likely that what's developing here is a ABC pattern. This would be your A, your B leg, and then your C leg would finish somewhere in this zone down here. That's more likely, and let me show you a little bit clearer picture on why that is the case in my book. When you go to the weekly chart, what you see here is a bearish wedge pattern, and this is the 6th week that we're in now from the last pivot low. So you have 1, 2, 3, 4, 5, 6, and generally speaking, from a wedge pattern like this, you're going to see one more leg lower, and this leg lower on the weekly chart would bring us down to the, or pierce through the 50 period moving average, and when you look at the daily chart, and that comes in at 97.5 roughly, and when you look at the, whoops, that's not the chart I wanted. When you look at the daily chart, the 200 period moving average on the daily brings us to 97.8 or so. So that coincides. So somewhere down in this zone, if that pattern off the weekly chart were to complete, would bring us down here, likely find a bottom in that zone, and we would be looking for a signal of a trend change at that point, and that's the one that would normally be a trend change for that one more run higher up to 105 and beyond in the dollar. That's what we're waiting for. So ideally, we'd like to get that flush down to the 200 period moving average or lower out of this wedge pattern. And with that, folks, it's everything I intended to discuss. It was a quiet day on a Monday, which is not that abnormal. We look for the volume to pick up tomorrow and beyond and see what we can find. So therefore, I wish you have a great evening. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.